Well, top of the morning to you, everybody. Thanks for jumping on and spending a little portion of your St. Patrick's Day with us. My name is Lee Schwartz, and I'd like to welcome you to our webinar. Today, we're going to have our trio of experts discuss the latest business impacts of PPP and the recent stimulus plan. Now, before we get started, I just want to take a quick sec and tell you a few words about SVA. Our vision is to remain independent, and our goal is to continue serving the same clients we have since 1974. And that's closely held and family-owned businesses and nonprofits. And we do that by working collaboratively throughout the year with our clients in a consultative way. You know, it was actually just about a year now. It was last March 24th that we held our first COVID webinar. We've really tried to provide more information and assistance during this time than anyone else. We've conducted over 40 webinars and have had over 6,000 attendees. And here we are again. We're going to keep going until you guys just don't want to hear from us anymore. So we're going to leave a fair chunk of time at the end for Q&A. If you have a question, open up the chat box and submit it there. We're not going to answer questions as we go, but we will address as many as we can at the end. Now, if you're a client and your question doesn't get answered, we'd encourage you to reach out either to your SVA contact or to any of our speakers. If you're not a client and you have questions, please reach out to me and I'll make sure a subject matter expert gets your questions answered. All right, so most of you already are familiar with our speakers, but for you first timers, let me introduce Nancy, Dan, and Eric. So Nancy Melberg is a principal with SVA and leads our management advisory services team. Dan Glomsky is a CPA and a principal and leads our valuation practice. And Eric Trost is a CPA and is one of the leaders of our tax practice. They've got a lot of information to go over, and I will be back for the Q&A, but I'm going to kick it off to Nancy to get us started.
Good afternoon, everyone, and thanks, Lee. I am hesitant to welcome you all to our PPP book club because, as you're going to see today, we're going to talk about a lot more than the PPP on today's webinar. So we do have a brief outline on some of the things we're going to cover today, and we're going to get into some in a little more detail. And as Lee said, we're going to leave a lot of Q&A. So we are going to cover the new bill that was just signed on 3/11, the American Rescue Plan Act, or as Eric calls it, ARPA. We're going to talk about the restaurant revitalization, the shuttered venue operation grants, give you some updates on what's going on in PPP and answer any questions, and the employee retention credit, which seems to be gaining a little bit more momentum, I think, as time is going on. So let's kick it off right now and let's talk about some of the high points in the American Rescue Plan Act. So we wanted to just give you this little bit of a visual to show you that there's a lot more in this bill than what we're going to cover today. You will see a big chunk, 410 billions of dollars out of the 1.9 trillion are going to these stimulus payments that people should be seeing. My understanding is possibly by the end of the week. And actually if you go back one slide, Jennifer, on our webinar outline, we did supply a link if you want to write it down, or we'll provide this PowerPoint to go in and check where your payment is. So you can actually log into there and you can check the status of your stimulus check. So you can see on that, a lot of this stuff is outside of what we're going to cover. We're not going to cover the state and local government that they have some funding for. We're not going to cover the pensions, but we are going to try to cover some of these biggest points. So with that, let's jump into what we think is important for you to know in this ARPA plan. So one of the big provisions to this is they've extended the unemployment benefits. So they have now extended the benefits to 9/6/21. And some of those benefits include the number of weeks that someone can get unemployment from 70 weeks or from 50 weeks to 79 weeks. So when you think about it, that's a pretty significant increase in time. They are also offering an additional $300 per week as a federal supplement. So this is not going to come from the state funded. This is the federal from 3/14/21 to the 9/6/21. So this is going to provide 53 weeks of the federal benefits, which is up from the 24 weeks. So people are going to start to see a little bit more unemployment coming through. One other thing that I wanted to mention in this also includes the pandemic unemployment, that some of that was extended. And that pandemic unemployment, or PUA, I believe we saw it, was for the self-employed individuals. So if you were an owner of maybe an S Corp, for example, and you didn't pay into the unemployment previously, you were ineligible for unemployment benefits, but under this PUA, you are eligible for benefits. So also one of the big things that came out just recently is this first $10,200 in unemployment compensation is going to be tax-free. Now they made that retroactive to 2020. So anybody who received benefits and their individual income is below 150,000, you're going to be able to exclude the first 10,200 from your taxable income on your 2020 tax return. Now, I know there's a lot of individuals out there that have already filed tax returns, including those unemployment benefits, and perhaps paid tax on them. We are being told right now, do not file an amended return. The IRS is trying to figure out what to do with those. They are going to issue additional guidance. I think there is some talk about whether they'll just adjust it on their end and they'll just refund anyone the money that they paid. Haven't heard any more, Eric, Dan, I don't know if you've heard any more on that other than we got to wait for the guidance from the IRS.
Yeah, I think that's right, Nancy. The IRS said they're working on their system to maybe do this automatically so people don't have to file an amended return. And as a reminder, this 10,200, Nancy, you said is a 2020 provision. So it's last year, this year's taxes we're working on, but it's for last year. They have yet to make this apply to 2021. So right now it just does apply to 2020.
Correct. And Eric or Dan, I don't recall, has the state jumped on board with this?
We're waiting for the states to come out. And we have different resources we go to, which we'll be providing a link to on our website when it comes out, of which states allow this unemployment exception and which ones don't. That's going to change over time, so we plan on keeping that updated.
Yeah,
So
and Wisconsin hasn't done anything with this act yet. So that's the issue.
So this is going to be very similar to what we saw with the PPP, where we have to wait because every state is going to make their own decision.
I'm looking forward to it.
One of the other things is they're going to make the student loan forgiveness tax-free through 2025. We won't go into a lot of detail on that. I think one of the big things that everybody's asking is about these stimulus checks. And so as you saw in our first slide, that's the big chunk of where this budget went to. So everyone is going to be provided a $1,400 stimulus check if you meet these requirements. So if your household earnings were less than 80,000 for single filers, 120,000 for head of household, or 160 for married filing joint, you will get a check. There are going to be some phase outs. So we've got the phase outs listed below. So keep that in mind if you don't get the full check. And again, I encourage people, if you want to check the status of it, to go to that link that we provided and check for those stimulus checks. So another thing that they're doing is they are extending some of the tax credits and they're modifying them. One of the big ones is this child tax credit. So this child tax credit is going to increase to $3,600 per child for younger children. And for children the age of 6, it's going to be $3,000 per child. So again, there's going to be some phase outs here, $75,000 for single parents and $150,000 for couples, married filing joint. So we do have a little bit of phase outs there. This paid family sick leave, they've increased these eligible wages from $10,000 to $12,000 per employee. They've increased the coverage to 60 days, and they're including leave for self-employed individuals. And we're going to talk a little bit more in detail about this when we talk about the FFCRA. So keep that in the back of your mind. We're going to go into some of these details a little bit more.
Nancy,
Yes.
on that child tax credit, so that's for 2021, for the year coming up. The IRS has been directed to try to give advanced payments on that child tax credit based on your filed 2020 return. So that will be more checks coming out prior to the end of this year based on how the IRS sees a tax return would qualify under the income phase outs.
Thank you, Eric. That's great information. So also what they've done is they've added some additional funding to this bill. And so they've added 7.25 billion to the PPP program, which we're going to talk about in a little bit more detail. This is not a third draw. So I just want to make that clear to people. It's not a new application. It's not a third draw. They're just increasing the funding on that. They're also increasing the funding for the EIDL, or the Economic Injury Disaster Loan, by $15 billion. Now, keep in mind that EIDL is a non-forgivable loan. I'm sorry, it is not it's not a forgivable loan. It is a non-forgivable loan. So that one you will have to pay back. There is a low interest rate on that. And if anybody's interested in that, we can give them more information on that. They put 25 billion into aid for restaurants that Dan is going to talk a little bit more about, and an additional 1.5 billion to the already 15 billion in these shuttered venue operator grants that Dan is going to talk a little bit more about too. They have also extended the employee retention credit. So this is fantastic news, because this is a pretty lucrative credit for a lot of businesses that was set to expire on June 30th. And now they've extended this credit to 12/31/21. And we're going to talk in a little more detail about this and the timing of this with the PPP loan and give you some examples. They've also provided this premium assistance for the health insurance coverage, including anybody that's got COBRA, who is no longer part of an employer-sponsored plan. So there's a lot of good things in this plan, and we expect to see a lot of additional applications coming out and a lot of information. So just keep in tune with us. We're trying to stay on top of all this as much as we can. And so with this, I'm going to turn it over to Dan to talk a little bit about the restaurant revitalization.
Great, thanks, Nancy. The next two topics here we want to just quickly touch upon is one is the restaurants, and the other one are these entertainment facilities that are probably the most impacted industries with respect to the pandemic. So I just want to cover some surface knowledge just so that everybody's kind of aware of what these plans are, or what grants are available, and then kind of where your taxpayer dollars are going, and maybe what the government's trying to do to bring back some of these industries. So the first one we have is the Restaurant Revitalization Fund, and this is a grant, and the grant is equivalent to basically the lost revenue between 2020 and 2019. And it has some limitations with respect to, you have to have fewer than 20 locations. The maximum credit or grant that you can apply for is $5 million per location and $10 million total. And then there's an additional kind of bucket set aside for the restaurants and businesses that are below 500,000 in gross revenue. So that's really good things. I think it's an opportunity for these restaurants to try to recapture some of the losses that they had in 2020, and hopefully it'll get back to until the pandemic is able to, everybody's vaccinated and things are starting to pick back up. There is also a period of time where the first 3 weeks here are kind of opened up for the veteran-owned businesses and women-owned businesses. But the reality of it is right now, SVA, the grant gets filed through the SVA, and the SVA isn't really ready for the application. But once they are ready, that's one thing that we'll definitely see a lot of activity on, and obviously encourage the restaurants business is to go for that. The other one I want to talk about is the shutter venue operators. And that has to do with, these, and today we hear the news that Summerfest lost $8.1 million last year before depreciation and 17 million after that. Well, Summerfest is planning on applying for this grant and can get up to $10 million of grant money for their venue. And it requires you to have like a fixed seating and stuff like that. So these mobile entertainment facilities, they're not able to qualify. You really have an established location with fixed seating and so forth. But here's kind of a list of the museum operators, the theaters, the motion picture theaters. You can't be publicly traded, so like Marcus Theater is not going to be able to apply for it. But there's certainly a good population of people that would apply for it. Some of the nuances with respect to this bill relate to whether the how much can I get, right? And so the criteria for determining how much you can get is 6 times 45% of the annual 2019 revenue. So if kind of like we were looking at the PPP, we would always determine how much monthly our monthly payroll costs were. Well, in this case, we're looking at our monthly revenue generation, taking that times 6 times. And so basically 6 months, and then we get 45% of that. So that's the amount of the grant. There's also a second opportunity starting after April 1st to get an additional 50% of that initial grant money. And that grant money can be used for payroll costs, rent, utilities, and personal protection equipment, all the things that I think these industries are going to need in order to get them back on task. And then as far as some of the other nuances we want to pay attention to, and the the grant is tax exempt, at least for the federal level. So that's great. We also have to remember that service and support companies. So if I am hiring a lighting crew, if I'm hiring the lighting crew company would not be able to apply for this grant. So it's the actual venue that has to apply for the grant. And so the support groups don't get this ability to apply for the grant. And you need to work directly with the SVA, again, similar to the restaurant revitalization fund. So again, we work with the SVA to get this money. And then a couple interplays with respect to the PPP. If you've applied for the PPP loan before December 27th, there's no reduction in your ability to request the grant. If you apply for the grant post December 27th, then you have to adjust it for the PPP money received after the 27th. And then, so let me just rephrase that a little bit. So that if you apply for the PPP money before December 27th, and then you apply for the grant, which happened after the December 27th, that grant would be reduced by the amount of the PPP funds that you've already received. If you apply for the PPP money after March 11th, you are not able to apply for the grant, so the Shutter venue grant. So just be prepared of those. Nothing that I think is all that hard to comply with, but just want to be prepared for that. All right, so I think from here we'll turn it over back to Nancy to touch base on some PPP activity.
Thanks, Dan. Now back to my favorite topic, PPP. So $7.25 billion added to the fund. So what does that mean? Well, as of March 7th, they had dispersed $687 billion of the $796 billion that was allocated, but that was before they added an additional 7.25. So they're at about what, 803, 804 million. They've already dispersed 687. So I definitely think there is some opportunities for people who haven't gotten a PPP yet to certainly get out there. And actually the most exciting part of this slide is the highlighted part at the bottom that I'm going to jump to right away, is that the House just passed a bill to extend the deadline to apply for the PPP until May 31st. So previously it was March 31st, which is just a couple of weeks away. They've now extended that. I know that we were pretty confident all along that they wouldn't disperse all the funds by March 31st. And so we were kind of telling people not to worry about it. It is possible now that they could disperse all those funds by May 31st. So with this extended deadline, we're going to talk to everyone a little bit later on the employee retention credit on how to possibly maximize how you could get both credits and the timing of them. Because if you have not applied yet for the PPP, you may want to even wait a little bit longer to apply, but there is a chance that the money could run out. But we'll show you that, an example of that a few slides from now. So one of the other things that they've done is they have extended some of the eligibility. They've extended it to additional nonprofits and digital news services. So previously, nonprofits who were associations were not eligible to apply for the PPP. They are now eligible to apply. And these would be draw one applications for those particular companies because they were not eligible. They never applied before. So it still would be considered a draw one. They have also increased the lending capabilities of self-employed individuals. So this is really important because if you file a Schedule C, if you're a self-employed individual, previously the maximum loan you could get was based on your net income. So it was based on your 2019 Schedule C net income divided by 12 times 2.5. Well, we know that the net income for a lot of Schedule C filers might have caused them to not hit that cap. And so they were seeing very reduced amounts in their PPP loans. So the SVA understood that, and they have now been generous and increased that to gross revenue. So now you can take your gross revenue and you can divide that by 12, multiply that by 2.5. You are still capped at $20,833. However, that should be, or hopefully is, an increase for a lot of people who have applied. Now, if you've already applied for a second draw PPP or perhaps your first draw and you were under that limit, you have the opportunity to file a new form. So the 2453C is if you're a first draw applicant, 2483 SDC is if you're second draw, thus the SD. If the bank must submit this form 2484, which is a loan guarantee. If the bank has not submitted that yet, then that's not a problem. You can just fill out this application. They'll withdraw their original form, and then you can fill out a new form. If the loan has already been dispersed, but the bank has not filed the paperwork with the SBA, which is a 1502, what a borrower needs to do is they need to pay the loan off in full, and then they need to reapply with the 2483. And then they'll kind of go through the process again. The lender, if the lender has already filed the 1502, which means you've already been dispersed the funds and you've signed off on all the documentation, then unfortunately there's nothing you can do. However, if it was your first draw, you still have the ability to apply at this higher amount with your second draw. So I know there's a lot of information there, but I think that's really important for all the Schedule C filers to get the maximum amount that they can get for these draws.
So Nancy, can I ask a quick question as far as can you share with everybody kind of what we're experiencing from the perspective
Absolutely.
of the loan application process? Are those things, are they being processed? I've heard a lot of things about error codes. We're kind of working through them with clients. Just kind of interested in your perspective on how things like that are going.
Yeah, so a lot of the banks had previously shut down, and I don't know if the last time we gave this webinar, if those applications were being held, but there was a period of about 30 days where a lot of banks shut down. And the reason they shut down is because they wanted to get their portals ready, because they did change the application forms, because again, this PPP keeps evolving. And so they need to make sure that they're changing their forms and the information. Now, once they reopened, we started to see a lot of error codes getting kicked back and a lot of applications rejected. And some of the rejections that I have seen personally is lack of documentation. And so one of the things that I am seeing that whether this is coming from the SBA or the bank, but they have been very adamant on, is that if you are not with a payroll service and you're processing your own payroll, you have to provide them bank statements that reconcile all of the payroll cash disbursements coming out of the bank statements and tie them back to payroll reports. So I understand it is a lot of administrative work for people. I have actually helped a couple of clients go through this process, and it is quite cumbersome, and you have to really put some good spreadsheets together to tie it all out. But once we supplied that information, it appeared the application was accepted that day, or for actually both of the clients that I went through this process with. I am also seeing error codes for incorrect federal ID numbers, which we're struggling really hard to clear up because they're saying that it's not the correct EIN number, but it is the same number that the tax return was filed with. So we're actually getting a little bit frustrated with this process because I don't even know how to correct it beyond that. So we are seeing some very odd error codes coming through that is requiring a significant amount of time to try to clear up. But I'm hopeful that if they've spent the money on the qualified expenses, they're in the timeline, we have the documentation, it's just going to be a matter of time and they will get approved. It's just going to take a little bit more time to get all the information gathered.
And I think, Nancy, another thing I'm seeing is a couple of times we have, forgiveness applications where you say, how is that going? And your clients will say, well, we're still waiting for approval. Well, then, they contact the bank and all of a sudden we find out there's missing information, right? And the bank just hadn't communicated that with them. So I would suggest if your forgiveness application is sitting around, it hasn't been forgiven, unless it's one that's over 2 million. And I think in those cases, we're dramatically waiting on time beyond 90 days for some of these. And quite honestly, I haven't seen any approved for over $2 million. So, but you need to make sure that you're active in that process. And if your lender hasn't approved the forgiveness, that you're getting in touch with them, because there might be this missing information issue.
Yeah, and one thing I highly encourage is, I think most of the banks had portals set up where you put your application information in. It provided you a username and a password, and you can go into that portal at any time and see the status of that application. And it will tell you if it's pending bank approval, pending SVA approval, pending additional information requests, pending signature, some of them say, because they just have to sign off on the loan. But I've actually had a client send me one this morning that they showed all of the milestones that the loan went through. And so it said bank approved. We were first pending additional information, bank approval, signature. So I would encourage everybody to log into that portal. I thought they would be automatically sending you notifications, but the other thing that I'm seeing is that sometimes the bank, the email address that the bank has might be the email address of a shareholder that's not involved in this application process. And perhaps they might be getting the notification and not even understanding what it is or thinking it's spam. So you got to be careful where those notifications are going to as well. The only other thing that I wanted to touch on here is, I think since our last webinar, we have found that the PPP is not going to be taxable for Wisconsin. So this was a big win for everyone. We got the break from the federal, now we get the break from the state. So yeah, I think all great news on the PPP front.
Yeah, and Nancy, to add on that, a lot of other states are also changing their course of action. I mean, Minnesota's starting to discuss whether it's possible that they might also change as well. So it's Wisconsin's definitely a leader from the perspective of allowing it to be non-taxable, but we're also seeing other states coming online as well.
Wow, so Wisconsin is leading.
Yeah.
Nice and refreshing. I think with that, what we are going to do is we're going to jump over to the employee retention credit to kind of wrap up the PowerPoint section, and then we'll take some questions after that. So Eric, I'll let you take it away.
Yeah, thanks, Nancy. Actually, can we go back one slide? Just want to comment on one of the things that you highlighted on here. That House passed the bill to extend it to May 31st instead of March 31st. So the original due date was March 31st. The House passed a bill that says the due date's going to be May 31st. That's not law yet. We expect it to be law. It passed the House like everybody to 3, and who knows, those 3 people could have hit the wrong button. So it seems very bipartisan and it's got support. I think it is likely to pass, but it's not law yet. So I just want to make sure that that is out there.
Yeah, thanks for pointing that out, Eric. I guess I just got overly excited over.
Yes.
It would definitely help a lot of situations. So
Yes.
I feel your passion, Nancy.
All right. So talking about the ERC, the employee retention credit, what I want to do is review some of the qualifications here. So this isn't going to be a new slide or new information, but it's going to be a recap of past information that we've discussed before. It's somewhat complicated, so I wanted to review it again. This can be a fairly significant credit, so it's important that you understand it in case it applies to you, because you definitely want to get into this credit. One of the big differences between this credit and the PPP is that this credit, there's no attestation of a need or anything. It's a very mechanical test. And if you meet these mechanical tests, your company's going to qualify for these employee retention credits. So review the qualifications again for 2020. So this credit is available for 2020. And it is available if there was a 50% decline in gross receipts for any quarter in 2020 relative to that same quarter in 2019, or if your business had a full or partial shutdown. For 2021, the rules changed and made this easier to get from a mechanical standpoint. There would have to be a 20% decline in gross receipts. So that 20% decline in gross receipts applies now for any quarter in 2021 relative to that same quarter in 2019. So you've got, now that the credit's been expanded through the whole year, any quarter in 2021, first quarter through fourth quarter, if there is a decline in gross receipts for that quarter relative to 2019, then that quarter's wages can qualify for the employee retention credit. And you might ask, what's the logic behind comparing 21 to 2 years ago in 2019? It's really comparing a pre-COVID year, which is all of 2019, with a post-COVID period, which is now in 2021, we're in post-COVID. There's an additional ability to get this credit if there is a 20% decline in gross receipts for a prior quarter, not any prior quarter, a prior quarter, relative to that same quarter in 2019. So you're looking at the slide, and what I said is different than that in the slide, and that's because I don't have good handwriting. So I didn't see this to the end, but on that second bullet point, I just want it known that that's a 20% decline in gross receipts for a prior quarter relative to that same prior quarter in 2019. We will be updating this before we make these slides available to the public. Just don't take a picture of this one and start walking around with it like it's the rule, because it's not, unless you're going to cross it out and put what I said on. Or a full and partial shutdown, again, for 2021. So again, these are the ways to get qualified for the employee retention credit. We've got a couple examples below here that show that how this credit could work. So the example I want to point out happens to be for fourth quarter of 2020. Let's assume that there's a 25% decline in gross receipts for the fourth quarter of 2020. That decline won't allow you to take the credit for 2020, but it will allow you to take the credit for the first quarter of 2021 because it is a prior quarter. So you can use the prior quarter rule. So if there's a 25% decline in gross receipts for the fourth quarter of 2020, you can take that credit in 2021. I use 25%. It's a random number. It's just got to be greater than 20%. Second example is, let's say that there was a 60% decline in gross receipts in the fourth quarter of 2020. That allows you to take the fourth quarter 2020 wages for the employee retention credit. And also you can take the 2021 first quarter wages for the employee retention credit. So that 60% decline, it makes you qualify for both 2020. And because it's a greater than 20% decline, you qualify for the first quarter of 2021 as well. So these calculations can get complicated quick. I encourage you, to be looking at your quarterly sales and look over these with your advisors so that you are taking maximum benefit from this credit. One question we have that's been brought up by some authors is, can you use one quarter's decline to take both the employee retention credit for that quarter and then again for the next quarter? As of yet, we don't have the answer to that, but a plain reading of the law says you can. And so that's how we are approaching it, unless we see IRS guidance that dictates it's different. Next slide.
I would like to remind everyone real quick too, before we move on, that this credit is taken on your quarterly payroll reports. So we get that question quite a bit. There is a form that you can fill out to take the advance credit. However, what you do have to be cautious of with the advance credit is if you take too much, and then when you're doing, the reconciliation of it, and you've short paid or you've received more than you're entitled to, you could be up against penalties and interest for short paying payroll taxes. So just be cautious of that. I think we're seeing most people just waiting and taking the credit on their 941 and getting it refunded. So they've paid it in and then they're getting it refunded.
Yeah, so Nancy, where I've seen it is we've done some 941Xs, which are amended quarterly payroll tax returns to take the credit. And then we have some clients that are going to get it for the first quarter, and they could have short paid their payroll tax deposits. They did not do that. They wanted to make sure that they were going to meet a test. And so they're going to take that credit on the 941 that's filed for the first quarter, which is due on, I think it's April 20th or April 30th.
April 30th.
Okay. The maximum credit has also been expanded. So for 2020, the maximum credit was $5,000 per year per employee. In 2021, it is $7,000 per quarter per employee. So that's up to $28,000 per employee per year if a company would qualify for all 4 quarters. So it can be, again, a very significant credit. And it's important that when you're going through your sales on a quarter by quarter basis, that you're looking and making sure you've taken into account all the adjustments that you should take into account. So you've got a proper measurement there. Now with the employer retention credit, you can't take the credit on the same wages as you're taking, as you're paying with PPP money for. So there's some planning that goes into this that I'm going to shortcut a little bit because I want to get to the Q&A. But the planning is basically, you want to use the PPP money because that's a dollar for dollar expense reimbursement and it's not taxable. Whereas if you use the ERC against wages, that is a 70 cents on the dollar credit, and that 70 cents is actually effectively taxable income, which makes it a 50 cent on the dollar after tax income effect. So you'd rather use the PPP than the ERC, but actually what you'd rather do is use both. And so what you want to do with your planning is try to make sure you're maximizing that ERC availability and then taking everything against the PPP so that you use the last dollar of the PPP for the wages expense and other expenses that it can be used for. And sometimes this has to do, you can work out your timing with this, and we gave a timeline example at the bottom of this slide. Basically, it's looking at taking PPP funds and using them for wages during your covered period and using the ERC credit for wages outside your covered period. That's a simple way to look at it, but it gets more complicated because you can take the same person who had wages in a quarter, and let's pick an example of someone who got paid $13,000 in a quarter. You can use $10,000 of those wages for the ERC and use $3,000 of those wages for the PPP. Or you could take $8,000 of those wages for the ERC and then use the balance, $5,000 for the PPP. So you've got a lot of room to play with how you declare dollars and what they're used for to get the maximum ERC credit and also get full benefit of getting the PPP forgiven. And then one last slide I wanted to go over, and this is a credit that's somewhat been forgotten. It's not
Eric,
as big
I'm
as
sorry.
ERC. Oh yeah.
Eric, I don't mean to interrupt, but can we go back one slide? I just want to point one thing out before we go on. In this timeline, I know we did a very simplified timeline. Oh, and I see we have the year wrong on that, on the 24-week covered period. There shouldn't be a 4 at the end. But one of the things that I wanted to point out is you don't have to use the full 24 weeks if you're taking a PPP. We just did it just to give you an example of the timeline. But really what you would probably want to do is stop your covered period as soon as you've used all the money. So if you happen to have used the entire PPP in 12 weeks and you have more than enough expenses to cover it, you want to stop it at 12 weeks so you can maximize your ERC credit as well. So I just wanted to point that out, that it doesn't have to be a 24-week period.
Yeah, thanks, Nancy. I think that's so that's important on how flexible these things are to allow maximum usage of both the PPP and the ERC, you know, in the same time periods.
And another thing you should be aware of is when you fill out your loan forgiveness application, you want to make sure at this point, if you're filling them out now versus maybe 8 months ago or 3 months ago, you want to make sure that you're picking up the rent and the employee benefits and everything, not just the wages, because at this point it could cause some limitations on our flexibility. So just kind of keep that in mind if you're filling your application for forgiveness, that you include every possible expense you can on that forgiveness application.
Yeah, so that's key when you are using both the PPP and the ERC in a quarter. If you qualify for both, the PPP can be used for other things other than payroll, whereas the ERC is just on payroll dollars. So you want to maximize the PPP usage on things other than payroll to squeeze the most benefit out of it.
But not beyond 60%.
Yes, thank you, Nancy. Not beyond 60%.
Yeah, I always got to hold us back, Nancy. I don't know.
I know. She's our voice of reason. The next slide is the Families First Coronavirus Act. That was passed last year. And just to recap on that, there is a tax credit available to companies that pay wages for employees that are out of work due to COVID, whether the employee has COVID or is getting diagnosed and waiting for the test to come back, or taking care of someone with COVID, or taking care of kids who can't go to school or daycare because it was a COVID-related shutdown. So there are credits available for wages paid for those employees, and those credits are 100% of the wages that were paid. So we filed a number of amended payroll tax returns, that's that 941X, to take some of those credits from the past. These aren't as big as exciting as the PPP and the ERC, but they still can be thousands of dollars of credits that you don't want to pass up.
Now, one thing I would like to add to this, because this is something that I think is really, really exciting to any self-employed individuals. So any self-employed individual can actually take the FFCRA credit, and they can get a credit of up to $511 per day for 10 days, a direct credit if they were sick. And let me back up, it's actually a maximum. So they're going to prorate your 2019 Schedule C, and it's going to be the maximum of up to $511 per day, or your prorated Schedule C. If you were sick, if you were caring for a sick person, it's $200 a day. You can take a family leave as a self-employed individual that can be as much as $200 a day for up to 50 days. If you had kids that were unable to go to school and you had to stay home with your kids. So I think this is something that a lot of Schedule C filers have missed. Now, this is on 2020, so it's the returns we're filing right now. And there's a form 7202 that gets filed and attached with your tax return for 2020. So these are, again, some pretty big amounts that we want to make sure that everybody is aware of.
Thanks, Nancy. So Lee, we wanted to leave about a half hour for you to moderate questions. How did we do?
You guys did better than times past. We at least left some time. But no, this has been great. You guys had a lot of, I think you've already through. So great job. And let's just dive right in. I think as we, as you guys went through everything, let's kind of go through in the same order. We've just had a lot of ERC questions coming in as well. So let's start with the unemployment, some of the unemployment questions. There was a question, is the IRS updating the forms to claim the non-taxable basis for unemployment benefits for those who have not yet filed 2020 tax returns?
We don't know yet.
Yeah, we don't know, but the IRS does have instructions for it. So the IRS has issued instructions on how to report the unemployment tax benefits on its current forms.
Okay. Do the unemployment benefits extend to self-employed single member LLCs?
Yeah, so actually, I happened to see that question go through, and I actually had pulled up. So on the Wisconsin unemployment site, so it says that they're anticipating a lot of payments due to the extension of the PUA, and that they're going to start processing those the week of April 24th. And according to the Wisconsin website, those are going to be available for up to 79 weeks of pandemic unemployment. And that is for self-employed individuals.
Okay.
And they will also make the payments retroactive, and they'll give them back pay. Sounds like they're a little bit behind on actually processing the payments, but they will go back, and it says that they will receive all their back payments due.
Eric, I think this one might be for you. There was a question that came in asking about how the R&D credit plays in with the PPP and the ERC. Can you talk about that?
Sure. Wages can't be used for both the R&D credit and the ERC credit. However, wages that were paid for by the PPP can be used for the R&D credit. So what we have right now for information is that PPP funds used for wages, R&D credit, okay. ERC wages and R&D wages have to be separate though. Can't use the same wages for both.
Okay, great. We have a lot of ERC questions. Let's jump into some of those. Are 100% S Corp owner wages eligible for the ERC?
Yes.
Great.
100% owner, if you're 50%. I mean, isn't there, Eric, isn't there a requirement on the 50% or less ownership?
For relatives, there is. So I think the ERC rules on that are interpretive, but they do have a rule that your relatives can't also get the ERC.
Okay, hang with me on this one. It's a little bit long, but if you already applied for PPP forgiveness in 2020 and were granted that forgiveness and used only wages for ease of forgiveness application, is it too late to readjust the use of PPP loans in order to take advantage of more ERC?
Yeah, the IRS would say, yes, it's too late. They put out a Q&A already on that with that exact question and said, you're basically stuck with what you did there. That's an IRS interpretation that I'm not sure it really is correct or not. I don't know that you couldn't go back and adjust your PPP calculations and say, I could have used other expenses and instead I used all wages. I don't know that you couldn't go back and adjust that, still get the same PPP forgiveness and then use more ERC. But as of right now, you would be fighting the IRS on it because the IRS has a stated position you can't do that.
And I guess my opinion on that might be a little bit different than Eric's, and my concern is only that if you have, the only way that you could take the ERC at this point is you'd have to amend a 941. And if you have already provided 941s to get your PPP loan forgiven, they've relied on that information to accept that application. And now you're going back and amending something that you've already used. So I guess in my mind, it was a little bit like filling out a tax return with high income to get a mortgage. And then when you get the mortgage, you go back and amend your return and you don't claim any income. So I'm not sure. I guess we'll have to wait and see if there's any more guidance on how the IRS interprets that.
Yeah, I think you want to add to that, though. There's a lot of political push that stance that the IRS took was not appropriate.
Right.
Meaning that you're really penalizing people for using the ease of administration and not necessarily a motivation to, report a higher number and stuff like that. So there's definitely a lot of traction out there that potentially could change this. But you're right, Nancy. I mean, at this point, we have the IRS's position. And unless it changes, Eric's right. You would be fighting against the IRS on that. But I think there's hope that there might be a revision to that, and it might take some legislative change to do that.
And I think the problem was there was an unknown. We didn't know this other stuff was available when we were processing those original, everyone was processing those original applications. So it was kind of that they were changing the rules as the game was being played. So hopefully they will realize that and they will go back and change the rules back to the way they were.
I mean,
and that's a good point, Nancy, is the ERC at one time was not available if you took PPP.
Mhm.
And that rule changed, and that didn't change until the end of 2020. And by that time, a lot of people have already filed their applications for forgiveness.
Right.
Right, and we have a lot of, the 2020 ERC requires a 50% or greater reduction in revenue. So I think the population that is affected is probably less. But I mean, the reality of it is it's still something we're watching. We're pushing for a change, and we'll see whether we get there.
Okay, so we've had a lot of questions about upcoming legislative changes. I'm not going to necessarily get into the specifics of all those because sometimes predicting what Congress is going to do is a fool's errand. But I'd like, this is a $1.9 trillion bill. There's been talk of additional stimulus. Can you guys just talk broadly about what you expect to see in the long term from where this money comes from and changes legislatively that might happen to help pay for it?
Yeah, well, it comes from the money tree, so I'm not worried about that. There's actually potentially more stimulus coming. Someone mentioned the GEMS bill, which is aid that would be directed specifically for like health clubs. So that's got some momentum. That is a possibility that could pass. I think so. There's still some targeted relief out there. But after that, without question, there's going to be a tax increase. And it's just a matter of, how that is all negotiated. But there will be tax increases coming. And I think the question is, will those tax increases be effective in 2021 or 2022? And I'll go out on a limb here, but I think it's not going to be until 22 that the tax increases are going to go into effect.
Eric, can I just clarify when you said Jim's bill, it's GYM, not JIM?
Yes, that's correct. It's GYMS, as in gymnasium.
I was wondering who Jim might be.
Jim
He's got a
B.
good legislative backing behind him.
So I know there were some questions around what you guys are seeing for loan forgiveness. Nancy, you had a chance to comment on that a little bit. I know we've got some bankers on as well, but we did have another question that came in about what range are you seeing for forgiveness? Are larger loans slower? What type of limits? And I'm just curious if you guys want to comment more on what you're seeing from your clients, but also I'd be happy to share too. If any of you bankers that are on want to briefly share, I'd be happy to read that off as well.
So I think as Dan indicated earlier, I don't think we've seen anybody with a loan over 2 million that has actually received forgiveness yet. I think those are still under examination or audit. For the other loans, honestly, I've seen loans for 20,000 get hung up, and I've seen loans for 1.8 million go through in days. So I think it's just a matter of having the appropriate documentation provided, making sure that the documentation is clear. And I do think, and I apologize to any bankers on the webinar, but I think some banks are somehow able to process them a little bit quicker. I honestly don't know why, but I have seen some banks that have taken weeks and then other banks that have taken days. So I don't know if that's their relationship with the SBA, just their underwriting. I'm not sure what it is.
So another question that just came in was, is the guidance for 2 combined PPPs being over 2 million still not being automatic audit? I'm not sure if that's worded exactly the way I want, but is it a combined PPP of 2 million or is it each individual one, guys?
I believe it's a combined. Eric, do you recall?
I think it's combined also.
Yeah.
That they're looking at it to do that.
Okay. Let's go back to some of the ERC questions. How are gross receipts defined? This is an accrual basis taxpayer. Does that mean it's just gross revenue? Do investment incomes have to be included in this calculation?
So the gross revenue at this point we're looking at is really the sales or trade of business revenues. There is some guidance out there with respect to whether investments, whether if I were to sell a stock or some property or something like that, would I have to include those gross receipts? And that is at this point not the case. So it's really intended to be, what's your business activity and whether there's a reduction there. Is there an opportunity to maybe leverage some different data points and be eligible for the credit as a result of it? That'd be case by case situation where we kind of have to look at the type of activity that's being included. But investment income at this point is really not the intent of the gross receipts analysis.
And you do not include any PPP funds received also. It is not included in the calculation.
It's a good point, Nancy.
So if you've already filed your 2020 taxes and you go back and amend the 941 for last year, will you have to amend your 2020 tax return?
Yep. If you claim the credit, against those wages, you have to go back and amend your tax return to reduce that amount of wage that you received the credit for. So if you're going back to 2020 to claim the 941 adjustment, you have to go back to that 2020 tax return and adjust that accordingly as well.
Dan, do you think that's true for a cash basis taxpayer?
That's what I was just going to ask.
I do, because although you didn't get the credit, the wages that you're using that are credit eligible get reduced.
And you don't think we'll have an opportunity to pick that up in 2021?
You might be able to, right? But my opinion would be that that you would have to adjust whether you're cash basis or accrual, recognizing the credit wasn't physically received into your bank account until the 2021 tax year. But I haven't looked into that in great detail, but that is my initial reaction.
Yeah, I mean, technically that sounds right, Dan. It might be that there'd be other positions that come out though.
Right.
Especially for cash basis.
We would look at the situation if if that's where we're in. All right, let's take one last question. Is an application required for the ERC, or if you qualify, can it just be taken? Is there funding for the ERC that can dry up?
No, there's no application. No, there's no limit to the funding. So this credit is basically been provided for and budgeted for. Some credits do run out, like a electric vehicle credit. If you don't get it on time, the electrical vehicle credit runs out. Funding, like for the PPP, could run out. This does not have a run out provision. So if you qualify for the ERC, there's no application. It's a mechanical test and you take it by either reducing payroll tax deposits, claiming it on your 941, or doing the advanced credit, which is like a form 7200, to try to apply for it and get the refund even before you've paid all your wages.
Okay, we've also had some specific questions coming in about the Restaurant Revitalization Act, about the shuttered venues piece. If you have those questions haven't gotten answered, please reach out to me. I'll work with our subject matter experts in hospitality and nonprofit to get those questions answered. And here we are, we're at a full hour. So I just want to thank Nancy, Dan, and Eric yet again for all that information. I know you guys do a lot of work to make sure you're up to speed on everything that's going on, and I know it's appreciated by everybody. So thank you guys. And I just want to let everybody know that you can visit svaaccountants.com/hub, where the recording of this webinar will be located, as well as the slides and the PDF overview of this most recent bill. And I just want to remind you all that the SVA team is only a phone call or an email or a virtual meeting away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not a client, please reach out to me and I can get you answers to the questions that you need. Thank you again, everybody, for joining us today, and have a great and happy St. Patty's Day. Bye-bye.
Bye.
Thanks.
So long.